Okay, so in this video, I wanted to talk about two things. Number one, what are index funds, mutual funds, and ETFs, and what are the differences between them? And then second, I wanted to discuss why I believe that ETFs and index funds are much more likely to outperform actively managed mutual funds. And again, all three of these give you the ability to buy hundreds of stocks and diversify your portfolio very quickly. Really what you can think of it as is buying a stock with hundreds of pieces of different companies all in one. First, what's the difference between a mutual fund and an index fund? Well, all index funds are mutual funds, but not all mutual funds are index funds. This is because typically an index fund is simply a mutual fund that is tracking an index. Basically, it's just tracking a certain segment or area of the market, or it's just tracking a certain size of company. These sizes typically are referred to as large cap, mid cap, and small cap. For example, SPY, its index is the S&P 500. OGIG's index is internet technology companies globally. IXC's index is energy companies worldwide. IHE's index is the US pharmaceutical industry. There's pretty much a market index for any industry as long as you can just imagine it. A quick Google search will help you find whatever you're looking for. Now you have to compare this to an actively managed mutual fund, which again is not an index fund because it's not following an index. These mutual funds typically have somebody behind the computer actively managing the holdings within your mutual fund. So basically, they're buying and selling stocks within that mutual fund. This person supposedly knows what they're doing. So obviously the goal of this fund manager who is actively changing the holdings within your portfolio is to outperform the market. The most obvious downside to these mutual funds is that they have really high fees associated with them. Basically, they're charging you for having an expert change the holdings within the account. These mutual funds can have fees as high as 2.5%. Let's pretend that the expense ratio is 2%, which again is very high. If you have $100 in a mutual fund and it has an expense ratio of 2%, every year they're going to come in and take $2 away from your $100 no matter what happens to the value of the mutual fund. Whether it gains in value or loses value, they're going to take that money away from you. Because index funds are just simply tracking an index or a certain area of the market, there's no need to have an expert constantly changing holdings within the fund. Because of this, the fees associated with it are typically very low. For example, VFIAX, which is just simply an S&P 500 index fund, has an expense ratio of just 0.04. So now what's an ETF? Really, index funds and ETFs are extremely similar. There are very few differences, but the most glaring difference is that an ETF you can trade throughout the day. It basically trades like a stock. With index funds, you can only buy and sell the set price set at the end of the trading day. There are other small differences, but really this is the only difference. With an index fund, you have to trade the set price at the end of the trading window. But if you're a long-term investor, which I hope that you are really thinking about 30 years from now, 40 years from now even. Meaning this difference really shouldn't matter to you. If you need more clarification on the differences between mutual funds, index funds, and ETFs, I highly recommend checking out Rose's channel. I'll link it below. Now at the very beginning of this video, I talked about how I thought ETFs and index funds were most likely going to outperform most actively managed mutual funds. Why did I say this? Well, let the data speak for me. According to a study that was released in 2018, over the 15-year investment horizon, so from 2003 to 2018, 92% of large cap managers, 95% of mid cap managers, and 97% of small cap managers failed to outperform their index. According to IFA.com, in two 30-year studies, the S&P 500 outperformed 97%, and in the other case, 94% of mutual fund managers. In addition, only about 12% of the top 100 managers repeat their performance in the following years. Therefore, it is not possible to consistently pick next year's hot mutual fund manager. So even if you're able to pick a very successful mutual fund manager who happened to beat the index, which is very unlikely, the likelihood of that mutual fund manager doing that again the next year is extremely low. John Bogle, the founder of Vanguard, famously said, "No matter where we look, the message of history is clear. Selecting funds that will significantly exceed market returns is a loser's game." Based on this, I feel safe in saying that most index funds are going to outperform actively managed mutual funds. So on top of the fact that most most of these mutual fund managers don't beat the market, there are also very high fees, as I had mentioned before, associated with these mutual funds. Again, these fees can get up to as high as 2.5%. So even though that doesn't sound like much, that very quickly adds up whenever you're talking about a time span of 30 years or even 40 years to a fund that is already underperforming the overall market. For example, using the compound interest calculator on nerdwallet.com, if you have an initial investment of $10,000 that returns approximately 7% over the next 40 years, that small investment will end up being worth approximately $163,000. This sounds great, but we still have not taken into account the fees associated with it being an index fund or an actively managed mutual fund. So let's pretend that this is an index fund with a very low expense ratio. With a quick calculation, you can see if you have an expense ratio of just 0.1%, that'll end up costing you only around $5,500. This leaves you with approximately $157,000 in the end. Not bad. But if you have an expense ratio of 2%, that'll end up costing you almost $80,000. This leaves you with just $83,000 in profit in the end. That's approximately half of what you were supposed to have. So in conclusion, indexing or using index funds and ETFs are much more likely to outperform a mutual fund, at least an actively managed mutual fund. This is because not only does the manager almost never outperform the index, on top of that, the fees associated with it are just too much to overcome. And again, this is for entertainment purposes only. I am not a financial advisor. Also, please subscribe to my channel. Thank you for watching, and I really hope that you learned something.